All right, well, let's go ahead and get to those questions via email. We're going to talk about setting up the Power Options tools to look for a specific short strangle. It's going to be a quick conversation, but there's some things we need to identify first. Then we're going to talk about to manage or not to manage a bull put credit spread that one of our customers recently had and decided to close early as the stock began to move against them. So we're going to take a look at that also. Let's get to question number 1. This one comes to us from Octavio. Octavio says, attached, please find a Tesla strangle I created in Thinkorswim. Can you share your opinion and maybe show how I could best recreate and improve it by using the Power Options tools? Well, I was looking at a particular structure 1 month out in time, using the October 270 put and selling the October 280 call, both slightly out of the money, getting a net credit of about $24 on the position. You got an upper and lower break even around 303 and at about 248 or so on the position. Tesla's currently trading at 273.58. It's really around 272 when I started analyzing this position from the email I got from Octavio, but the price changed. I think we closed right around 273.58. Now, the first part, addressing the search tools. Before we go into any analysis on this, Octavio, but again, you're going to understand my analysis when I break this down a little bit. To find trades such as what you're looking for, you just have to change the clashing criteria. So you just go into the search tool in Power Options, click on Short Strangle, click Clear Filters to start from scratch, adjust your desired expiration time frame. Now what you're going to have to do is change the percent out of the money range from 40 to 50, which is the standard on the default criteria. I'm sorry, 40 to 60 is the standard on the default criteria. You're probably going to want this to be less than 40 or less than 50. Remove the percent probability between. The default criteria is looking for a high potential probability between. A 10-point strike difference on Tesla, you're probably only looking at a theoretical probability the stock would be between the strike prices or between the upper and lower break even of about 45 to 55%. The default search is starting at greater than 70, so that is going to be out altogether. And of course, we're just looking for a small minimum net credit and percentage return of greater than 2, but that's pretty fine. But you'd want to put in that minimum net credit that you had of greater than 20. Okay, so easiest way to do this instead of continuing on with the slides is we're going to navigate right over to the Power Options suite of tools. And we're going to go through this together. We're going to walk through setting up the short strangle screen, analyzing the default criteria and what was shown, and why that necessarily didn't match the default criteria. So to begin, we're just going to go over to Power Options. And we're talking about a short strangle position, selling an out-of-the-money call and selling an out-of-the-money put against a position, hoping that the stock stays between those particular strike prices. Both call and put would then expire worthless. You'd keep the entire net credit. First, we don't have short strangle here on our webinar account, so we've got to go into other strategies. This shows my selected strategies here on the right, and over on the left are the available strategies that are available to you. So we simply just have to select our short strangle position, click Add to Menu, and that'll put it in our 9th tab on the configuration, and then click Save Configuration down at the bottom. Now let's just go to Short Strangle. There you can see the basic profit and loss chart of selling the out-of-the-money short put, the out-of-the-money short call. And let's go into the basic search. Now here we see some positions for Rivian, Coinbase, Moderna, Snowflake, Datadog, and so forth. We have a total of 18 results that match our default criteria on Power Options. Now we're looking for standard expiration. standard October expiration, which is 35 days out in time. Octavio's particular position was for the 6th of October. It was a shorter time frame, around 28 days, 29 days or so. So we're going to have to change that. Here's that percent out of the money range that I mentioned that we're going to have to lower in order to find the trades. And there's that probability between. Now, we may have to adjust some of the stock criteria as well. They're pretty basic. Stock between $20 and $200. Well, we have to change that, of course, don't we, to find Tesla. Looking for large market cap stocks, Tesla might fit in that. And because of the risk of this strategy, you're essentially selling a naked call and a naked put. We want to avoid earnings between now and expiration to avoid any sudden spikes in one direction or the other. So let's start from scratch. And let's go ahead and take a look with what we want to see here in this position. But before we do that, I want to talk a little bit more about this percent out of the money range to make sure that's clear, as well as the probability. So the percent out of the money range is showing you where the underlying price is in relation to the range between your sold put strike and your sold call strike for the short strangle, also for an iron condor position. A percent out of the money range of 50 shows you when the stock is trading halfway between the two, that it's equidistant between the short put strike price and the short call strike price. If I wanted something that had more of a bullish or bearish bias, if I had a more bullish bias, I'd look for lower to zero, meaning that the stock was closer to the sold put. I'm expecting the stock to move up but not breach that upper call strike price. If I was a bearish and I tried to skew a short strangle to a bearish position, we'd look for this percent out of the money range of greater than 90 or so, because I want to have positions that are in that upper end. Now, let's just take a look at what that means real quick. I'm going to take this Coinbase position. Stock's at 82, and here's a 95 and a 65. I think I want this one, the 100 and the 70. So we're about 12 points down and about 18 points up. It's not perfect. Is the Moderna a little better? 14. Nah, this one's probably the best one. All right, so well, it's not the best one, but let's go ahead and take a look at the profit and loss chart. So again, the percent out of the money range is showing us where the stock is in relation to that sold put and that sold call. Equidistant away would be exactly 50% OTM range. That's what it's referring to. Not how far the short call and the short put are out of the money, but this out of the money range related to where the current stock price is to both available options. So this is in that 40 to 60 range. The trade that Octavio mentioned, with the stock trading at 272, he was selling the 270 put. So we were at a much lower percent out of the money range that had more of a bullish skew, more room to move to the upside, more of a directional trade. He didn't feel the need for safety to the downside. Now, in addition to that, because it was only a 10-point spread on Tesla, that percent probability sum and probability between was going to be much different. All right, that's going to be lower as well. With that in mind, let's do what we said we were going to do. Let's start off with clearing the filters first. October 6 expiration is a little bit different. As I mentioned, it wasn't the standard expiration 35 days away, but it is about 30 days away or so. So let's go ahead and put in days to expiration 20 to 40, for example. That percent out of the money range, remember, we have to change it because it's skewed to the short put strike price. We're in that lower range of what we call the percent out of the money range. So we're going to drop that down to less than 40. Probability between, I'm not even going to use in this case. Okay, we're just going to leave that alone for the percent probability between, because it's just not what is necessary in this case. All right, you're looking for something specific. What was specific about it? Well, you had that skew. You're looking at Tesla, and you want a high net credit of maybe greater than 15 or greater than $20. Now, as always, I do want to see some activity. I don't want to see a large breadth of results here that come up in the search, where things that have a zero bid and a $10 ask, and we're using the midpoint to find the position. So I can control that very simply using the bid-ask spread. But really what can help that too is looking for a call volume greater than zero, a put volume greater than 0, and a minimum open interest of greater than 0, and a call open interest of greater than 0 as well. Now let's go ahead and submit that search. Just 4 or 5 criteria. Hey, we've got a Tesla in for the 20th of October, 35 days away. We've got one, some here you can see for the 6th of October as well. Let's change that to isolate it to the 6th of October that you wanted. Now that you know it's 21 days out in time, let's just go 15 to 25 days. Let's see what we get. But we do see the Tesla's in there, and the strike prices were pretty close to what we wanted. Now again, here's our results. All of them are focusing on the 6th of October, as I mentioned. We have 581 total results that match this basic criteria of what you showed me on the Thinkorswim in the email. Looking for a $24 net credit is what you got on the position. And with the skewed sort of range against that. Now, there's probably Teslas in here. We have MicroStrategy in here. I didn't change the earnings not before now and expiration. I would have added that back in, and maybe some of those other stock criteria as well. But you were kind of looking for these types of trades. You can further filter. We'll talk about them in a moment. But Octavio, let's just go here in the fundamentals, and let's just search by Tesla to see which short strangles matched against Tesla with that very basic criteria that we were looking for. That is very strange. The price might have changed. Let me up this. I think that's why the price was changing at the end of the day. I apologize. It worked at 40 when the market was open. Let's lower this to 50. All right. And there you go. There's your specific trade. The 6th of October, 21 days out in time. Probability between is only 57.9%. Probability sum of 42.10. We're going to have to add in that percent out of the money range. But right now, the net credit is 2070. Okay, so some of those other ones might have dropped. Let me put the net credit at 15 here. I know I'm making some subtle changes, but there were 4 trades that matched this criteria. When I was running it at about 3 o'clock, there they are. You have the 285, 265, 290, 270, the 280, 270 you mentioned. Probability betweens are all in that 57 to 60% range. Okay. That 70% default criteria that we prefer on the wider range would not have matched this. Also, we had the stock price restriction, which you can absolutely change as well. Now, I want to take a look at this percent out of the money range. So let's go ahead and change the columns real quick. There you go, percent out of the money range. But I also want to change the column order slightly. I want to put that a little bit higher up with the probabilities. So percent return, lower break even, upper break even. That will work for us. Let's submit and save that column order. Close the window there. All right, just got to resend that. There we go. So as I mentioned, your specific trade, the 280, 270, is more skewed to that side, so it's a 43.9. That's why my less than 40 didn't work. It was at 39.8 at around 3:30, 3:15 this afternoon. With the price changes we see up to 274.39 from 272, that percent out of the money range increased, which is pretty good. It's getting closer, again, as I mentioned, to that equidistant level. In fact, the 40 to 60 default would have matched that. But the other positions, the 285, 270, that skews it a little bit more towards the put side. Here's the 295, 270. Naturally, that's going to skew it to the put side as well, to where it's only a 17.6% out of the money range between the two. But you get a slightly higher probability between theoretical probability the stock will end up between the upper and lower break even in the case of a short strangle. Okay, so that's what you have to do. Simply adjust the criteria to meet your needs. You've got a very tight spread on Tesla that, let's close this in a little bit, that's a little bit more skewed. It was a little bit more skewed to the bullish side. It was looking more of a bullish position where you weren't as worried about it falling 2 or 3 points in the next 30 days, 21 days or so below 270 or too far below the break even down to 249.30. We were looking at net credits of closer to $24, Octavio, I understand, but because of the shift in the stock, just those 1 or 2 points as we entered the change of the day, the net credit dropped from about 24.10 when I ran it down to 20.70 already. or full cash secured naked put and secured naked call a 3.9% against the total monetary requirements of the position. That's probably not what you're using. Your broker's allowing you to use some margin. I understand that as well. But that's the key. If you're not able to find the spreads you want, it's because there's something that we're looking for that's likely more conservative, that's clashing with what you're looking for. Easiest step to make is to just clear the filters and start with the main criteria you wanted, that net credit of $20, no real stock criteria. But then you had to understand what you're looking at with this strategy, and that might have been what was rubbing you the wrong way. The percent probability between, I know you've understood that. You and I have talked about it before for iron condors and other positions. Percent probability above for bull puts or bear calls. The percent out of the money range is likely the more tricky one. It's something I like to use, like to be equidistant between the two short options. With this strategy or with an iron condor is more likely what I would trade than the short strangle. So low probability between the upper and lower break even. I think this is an aggressive strangle. Let's go to the portfolio because I did add this into our portfolio based on the search results we got. That's not it. That's for Bill's question coming up. I apologize. So again, let's go back here. Let's go back to that short strangle search we had. See if we can find that there. I have it. Oh, I have it right here. I'm sorry. So let's put this up to, I think it was 1180. Is that on the call side or the put side? I think it was, no, it wasn't. It was higher than that. I think it was 12 here, but whatever. We'll just put in 1220. But I think it was 1240 for the put and 1180 for the call to get closer to that $24 that we mentioned. Yes, you have a break even to 245 before you start losing money on the position at expiration. You have an upper break even of 304. That's pretty wide. But again, depending on what margin you're using, are you comfortable with this level of profit? Are you comfortable with this level of profit? Because what I'm looking at here is if someone tells me they're more comfortable with this $1,500 level of profit, you have $15 net credit instead of that, I might look at what it is to sell the 260 or the 265 put and the 290 or maybe 295 call. So I'm further out of the money, 10 points one direction, 15 points on the other. I still might be able to get $13 or $14 here. And here, of course, down here at $500, well, yeah, I could sell something deeper out of the money to get that higher percent probability between. And that better, of course, out of the money range where I'm not skewing it too much one direction or the other. So the second part, your follow-up, what do you think of the spread? I think it's too close, especially for a stock like Tesla. I haven't researched or analyzed Tesla. I don't have deep insight into what I'm expecting Tesla to do in the next 10, 15, or 20 days. Maybe a lower break even of 245 is highly unlikely to be hit, and maybe the upper break even is 304 is also very unlikely to hit. But remember, even if it's in here, if it's at that range of 265 or 260, just 10 points down, you've got to manage that short put if you don't want to be assigned shares of stock. If it's up at 282, 285, you've got to manage the short call so you don't risk early assignment and being short shares of Tesla. If it's going in that direction, especially, can lead to much larger losses. Yes, you've got the premium to counter it. I just think this is too close, too low of a probability for my comfort level. And originally, I would say the percent out of the money range was a little bit off kilter. It was a little bit lower. It was about 38 to 40% or so. And that's kind of bullish move. It's already moved from 265 up to almost 280 in the past 10 or 15 days. Maybe you think it's easing off based on your chart reading, and that's why you sold the 280. But the split here is just too tight for me, especially for 21 days out in time. I'd like a higher probability. I might be down to the 250 up to the 305, 310. Again, depending on what those probability betweens are. And again, I like to set my out of the money range to be right up between 40 and 60 as a default showed, so I'm close to as equidistant as possible between the two strikes. All right, so that's how you can set up the search, Octavio, to find your needs. Keep it simple. Yes, now you had 500 results. We narrowed it down to just Tesla using that field. But now, of course, if I want to lower these results, let's start looking for other criteria. Minimum call bid, minimum put bid, play around with the probability sum, the percent return, increasing, of course, volume and open interest. I just use that as a very basic one. Okay. Technicals, yeah, you're looking for more neutral positions. So maybe a smaller bandwidth, Bollinger bandwidth with stocks that haven't had a sudden breakout one direction or the other. And fundamentals, might look for a large market cap, strong earnings per share growth, something that reflects more stable stocks. And as always, of course, stocks that don't have an earnings between now and expiration. What that cut us down to, still 600. But start with your basics. What did you tell me? Hey, I found the spread on this other tool that's, roughly 21 days out in time, had a $20 net credit on the position, and it was a really tight spread. How come I can't find it on Power Options, or how can I use Power Options to find it? Clear the filters. Start from scratch. Put in your basics, and then continue to add criteria to results. Let's just review that very quickly. Even though we've reviewed it a little bit here, let's just review it again very quickly. This is the approach to use for any strategy. Raymond's got a question coming up on setting up the married put search for dividend stocks. We'll get to that after Bill's question that came in via email. With a specific criteria set, hey, I want to find married puts like this. I want to find covered calls in the money on dividend-paying stocks where the ex-dividend date is 3 or 4 days away, or a week or 2 weeks away, but expiration is 20 days away. Start from scratch. Go into the search. Click that Clear the Filters button. Enter in your basic criteria for your plan, provided that they're realistic. Touch on that in a moment. Then continue to add subtle criteria to narrow down the results. What's a good amount of results? I think 30 or less. 2 or 3 dozen results. Gives you a good way to start researching the positions. You don't like the first one, you can move to the second one. You don't like the stock chart on the second one, you can move to the third one. Oh, you traded that one before and it burned you. We're just going to ignore it like an ex-girlfriend and move down to the fourth one. It gives you a nice manageable list to go through with the returns you want, premiums you want, probability you want, stock criteria you want. That's the power of the Power Options tools. You can use our defaults as a stepping stone, but sometimes with a very specific criteria to target your goals. Clear the filters, put in your 4 or 5 basics first. Then start narrowing down. If no results appear, your criteria is too restrictive or your criteria is too unrealistic. What do I mean by unrealistic? Well, we talked a little bit about probability between here with the short strangle. I might talk about that. We're going to talk about that in a moment with the bull put credit spread. Sometimes I get a phone call and says, hey, can your search tool find a specific credit spread? Yeah, the search tool can find anything if it exists and it's realistic in the universe of options. I want a bull put credit spread that's 1 week out in time on a 1-point spread difference that has a 95% probability, but is also offering a 25% return or 30% return. If they're there, the system will find it. I would just start with that basic criteria. Clear out the filters, put in the probability I want, put in the strike difference that I want, the return that I want, maybe the minimum net credit, and then run the search. If I get anything, it's going to be biotechs with a 300 or 400% implied volatility, where they probably have a phase 2 or phase 3 drug trial coming up in 2 to 3 days, where the stock could gap up 20 to 30 points or 15 to 20 points, or could gap down 20 to 30 points or 15 to 20 points. Not something I want to trade. Not something I want to take the risk with when something you could lose 100% on. But if it's there, the system will find it. You can use the system to find the Tesla spread you were looking for, as we just showed Octavio. But again, for my preference, I'd prefer to look for something with a little bit more higher probability between. Maybe on a less risky stock, but that's okay. If you've got better research on Tesla, you've followed it more, you're willing to take some of the fluctuations because you strongly feel that in 20 to 21 days, it's going to be between those two strike prices, even if it goes below the short put or above the short call, or you have a management you're planning on doing with consistent adjustments. That's your game, that's fine. We just showed you how to set up the search to find them. Start with the basics, clear the filters, keep in mind of what some of those criteria are, such as the percent out of the money range, the probability sum, and the probability between, why they're there, and why we had numbers in there as the default criteria. When you ask, what do you think of the spread? Well, if it's against some of our default criteria or the opposite of our default criteria, I'm going to have concerns with it. But I might not have studied Tesla as much as you have. I could guarantee you I haven't. I don't look at it on a regular basis and try to find the patterns in Tesla and what it's been seasonally in September or related to the strike that's going on potentially. I saw an article today that said with the strike going on, it might actually favor Tesla to be a bullish move for Tesla with the strike going on. And if it starts to spread with UAW on the big three, Tesla's not going to be affected by that. The others might be. It might be a boon down the road, 1 week, 2 weeks, 3 weeks, right around the time frame of your expiration. We'll just have to see.